saying nothing is certain except death and taxes. And that tax impact is something you cannot escape, even in retirement. But there are some steps that you can take to help reduce the impact of taxes on your retirement savings. That's our discussion today. Thank you so much for joining us. This is What Your Money Would Say with my friend Andrew McNair, founder and CEO of Swan Capital. I am Luann Fulmer, and we're so excited to have you. Let's start off with this phone number 800-848-8768. That is the number to call to get on Andrew's calendar. Andrew and our team at Swan Capital would love to guide you about any questions you have regarding retirement. It's their goal to help you retire with confidence. Again, 800-848-8768. Call that number. You can even text the word SWAN if you prefer texting. Text the word SWAN to get on their calendar that way. And you can find us online anytime at swan-capital.com. Andrew, hello to you.
Hey, I'm so excited about today's topic. I mean, taxes. I'm glad someone's probably ate their breakfast because you could lose your appetite talking about taxes.
Now, I gotta say, you know why I get excited is because you talk about ways we can come up with strategies, hard, fast, legal strategies to save. Who wants to pay more to the IRS than we actually have to, you know?
Well, it's not patriotic to pay more, I can tell you that, or to pay double or pay twice. No
Yeah,
way.
exactly. All right, so we all know the only thing that stays the same is change, right? Things just change over the years. We've seen a lot of changes, especially by the way that we've been taxed.
Well, that's the truth. And the sad part is every administration, every time Congress comes to work, it's not like they just start from scratch with a new tax code. They just keep on duct taping the tax code together. And so if we go back to 1913, when we actually became a superpower without income tax, they thrusted us onto us this income tax that we have now paid, which was only a temporary tax, Luann, for
Oh,
the last 100 years. And guess what? They promised it would only be on the rich. Well, that didn't last very long either. So we know that a lot of times these politicians, they make promises about that the taxes will only be temporary. They'll only be for the rich. And they constantly change the story. And sadly, we get stuck with that and we're entrenched in taxes. Everywhere we look, we have cell phone tax, hotel tax, gas tax, and there's so many taxes that the same dollar that we make is taxed over and over again. And so if you just follow osmosis and you swim downstream, your family will pay taxes over and over again unless we use the tax code to our advantage. We use the legal and ethical loopholes that exist and we maximize our tax savings by strategically, one, taking care of our income tax, playing offense. How do we lower our taxes on our income? But then playing defense on how, then once we've made that money, how do we invest that securely and appropriately away from future taxation? And that's what we're going to talk about in today's show.
right. I do want to bring this up though. In our notes, I'm looking here. The very first sales tax was in West Virginia in 1921. And there are some states that do not have sales tax still to this day. So it's kind of amazing. So that means, like, I guess that's when they buy things, they're not being taxed on things. Amazing.
It is amazing how different states, we have clients in Alabama, clients in Florida, obviously. And so, the Alabamians will obviously have some lower property taxes, but
Mm-hmm.
Florida has no income tax. And so,
Huh.
again, they're all gunning for the same dollar of the taxpayer. And we just have to be very strategic. And this is why we structure our clients' financial plans in certain ways, especially if they have property in multiple different states to take advantage of each state.
Right, exactly. That's why a lot of people are moving to Florida because they're like, no income tax. That's awesome.
That's right.
You know? Okay, so what are some things then that we need to know about, how our different sources of income are taxed in retirement? Something very important that we need to be educated on.
Well, this is very important for the retiree because many times clients will have their money in IRAs, 401ks. That money has never been taxed. So the wiser perspective is to think of your IRA or 401k as frozen income. And so in our financial plan, we visually color code them to be blue, and we color code them blue so that clients realize like this is frozen income. Like every dollar that you take, no matter how much you grow it to, will finally have to be taxed, and they're going to force you to tax that at 73. Depending on your age at retirement, you'll be taking it out at 73, being forced to pay the taxes. And this is why it's very important that when we have someone that's 5 years from retirement or 5 years into retirement, that we're starting to shift as quickly as possible to tax free investments. And this is why, with the election results finally behind us, and we know that Trump has been really focused on lowering our taxes from tips to lowering taxes for seniors, but also we're going to try to keep that tax rate low that he started back in 20 after 2016. So we need to make sure that our families are taking advantage of this tax window that's going to eventually go by the wayside. And here's why: if we don't figure out the federal deficit and we don't figure out the federal debt limit, we're going to continue having this conversation of increased taxes. So don't let the Congress and the administration dictate how your net income is in retirement. Instead, while taxes are historically low, if we show a chart of the federal income tax since 1913, the average top marginal tax bracket was 54%. The average. Today it's 37%, and it's been 90% 14 times in US history. So when people say, can tax rates go higher? Yeah, they can go a lot higher. So if you have money in IRAs and 401ks, which I'm sure you do, that's where the majority of the population has their retirement accounts, you want to start heading towards tax-free investments. And there are 5 tax-free investments. There are HSAs. It's one of the only triple tax advantaged assets that exist. You actually get a deduction when you put money in there. It grows tax deferred, and you can take it out tax-free for healthcare expenses like Medicare and Band-Aids and crutches in retirement. Then you have municipal bonds. Those grow tax free. Now, again, the return might not be so complimentary, but that's why we try to maximize as much interest as we can out of municipal bonds if we're going to use that. Roth IRAs grow tax free, Roth 401ks and Roth TSPs. And then lastly is life insurance. Those are the 5 tax free vehicles. And so we try to maximize those vehicles for clients. Even if they're just working part time in retirement, there are things that we can do to maximize and continue to contribute to those. As long as one of the spouses is working, they can continue to contribute to one of those Roth IRAs, which creates a really great opportunity.
I love that, and I love how I mean, you just listed 5 tax-free things to do with our money. So, this is something that you do when you work with your retirees, and we are offering a chance for people to come in and actually get an hour of your time complimentary, right, Andrew? And they can talk to you about their retirement plan because they need to cover not only taxes and tax strategies in retirement, but there's a plethora of things that need to be addressed in a retirement plan, and everybody needs this plan.
Absolutely. I mean, I just met with a client that had $250,000 in CDs, earning about 4 to 5%. And what's sad is he had part-time income. He had $12,000 of part-time income that he was using as walking around money. He was spending it. And I said, why hasn't the bank come to you to say, hey, let's move $16,000 into your Roth IRA because you made this part-time income last year in 2024. You had this part-time income now in 2025. We can put $16,000 into a Roth IRA CD if you want, even if you want to keep it the same way invested. But now that $16,000 is generating interest that you're not paying taxes over and over again. And this is why, if you're working with a financial professional, you're working with a banker, you're working with a broker, many times they're so focused on the investments, and that's really important. But you don't want someone that's only swimming with their in the swim lane with their head down and not looking at the tax strategies and the estate planning. So if you're looking for really holistic advice, if you're looking for an advisor that is looking at the tax planning and estate planning for you, all you have to do is schedule a sleep study. A sleep study is a 1 hour complimentary visit where we sit down with you and give you a report card on all the areas that you're doing really well on. But we're also going to look at areas like long-term care planning, income planning, asset protection, to make sure you and your family have straight A's going into retirement. So to schedule this sleep study, all you have to do is call us at 1-800-848-8768. That's 1-800-848-8768.
And we thank you so much for joining us today. You're listening to What Your Money Would Say with Andrew McNair of Swan Capital. I'm Luann Fulmer. So, obviously, a lot of us are going to have Social Security as one of our cornerstone sources of income in retirement. Andrew, can you talk about the tax impacts with our Social Security checks?
Certainly. So, up to 85% of your benefits may be taxable with Social Security. So, if you file a federal tax return as an individual person, your combined income is between 25,000 and 34,000. You may have to pay taxes on up to 50% of your Social Security benefits. Now, if you file as an individual and your combined income is more than 34,000, which is not hard to do, up to 85% of your Social Security benefits will be taxable. Now, if you're married filing jointly, for example, and you're filing a combined tax return from 32,000 to 44,000, 50% of your benefit. If you're making over 44,000 as a couple, which again, I hope you are in retirement because it takes a lot to live
Mhm,
comfortably,
mhm.
up to 85% of your benefits may be taxable. So each January, you're going to receive Social Security benefit statements showing the amount of benefits that you received in the previous year. And so we talked about at the beginning of the show that changes happen. Like Social Security was not always taxable, but now it is taxable. And so the government constantly changes the rules. And so you constantly have to change and stay one step ahead of this bureaucratic organization that we just have to stay one step ahead of them.
Okay, so this is what you do. You are talking to people right now who are concerned about taxes impacting their retirement and their future. All people have to do is give you a call.
That's simple. We actually make it even simpler. You don't even have to call. You can just text SWAN to 1-800-848-8768. And the uniqueness here is, there's plenty of financial advisors out there, but the uniqueness here is we have a CPA in office, and that allows us to answer great tax questions that clients ask all the time. We have many business owners that say, Andrew, I just feel like I'm paying too much taxes. And then when we sit down with them, we say, yeah, it looks like you are. You're not taking advantage of the Augusta rule, which allows you to utilize your home for business purposes up to 14 days and write off the income for a reasonable daily rate of renting out your home. We look at strategies of looking at your P&L, your profit and loss for your personal finances and your profit and loss for your business finances. And what we do is we go through, and we're happy to do it, go through with a client and say, here's what your business is spending, here's what your personal life is spending. Is there ways to cross pollinate that in a legal and ethical manner where your business can start actually morphing around your life? And that's what I've done with Swan Capital. Like Swan Capital is the business I built around my life and around my expenses. And I made many of my personal expenses very cost shared with Swan Capital because it's my business. I get to do that. And so if you're a business owner, not a franchise owner or an employee, you have additional tax strategies that might be available to you. And that's why I recommend a lot of families start a small business. One, because your community needs it. Number two, because you can add additional income to your retirement plan. And number three, there's great tax strategies for those who take the risk of starting a small business.
All right, we are up against a break, so more to come. Here's that number again. Call or text the word SWAN, 800-848-8768. We'll be right back with Andrew and what your money would say. Hey, thank you so much for spending part of your day with us today. I'm Lou Ann Fulmer here with Andrew McNair. He is founder and CEO at Swan Capital. Many retirees depend heavily on Social Security, obviously, trying to maximize their returns. This is a really, really important income source. However, navigating the system's complexities is a little challenging, and a lot of us have questions to the best way to optimize those benefits that we're going to receive over our lifetime. So, Andrew, the question is, why does Social Security have to be so complex?
Well, there's been so many numerous legislative changes over the years that they've really just continually add layers and layers of complexity. I wish they really would go back to first principles and just start from scratch and say, hey, let's see if we can redo this that
Yeah.
maximizes it for the recipient. I mean, right now, you could pay hundreds of thousands of dollars over your lifetime between your employer's portion and your portion. But if you die, your family gets like a $635 death benefit. It's a joke. And it's really sad because I was just looking at someone's social security statement. And if you go on to ssa.gov and pull the statement, you can see for yourself how much your employer has paid into social security. Because again, they're doing the 7.5%, you're doing the 7.5%. If you look at the total that y'all have paid into social security, 15% of your pay, and then you look at the monthly benefit, Again, a stockbroker could have done better, a banker could have done better, an insurance company could have done better, which is really sad. So this Social Security operations manual is over 20,000
Yeah.
pages with 2,700 rules. And guess what? They just don't send it every year to the taxpayer saying, hey, you might want to read this before you take Social Security. No, we have to navigate through all of these rules and these pages and try to remember it and see if it applies to us. And this is why mistakes can add up to tens of thousands of dollars over a lifetime. And we can't just make this decision about Social Security so flippantly.
No, we really can't. I mean, talk about complex. 20,000 pages and then all those rules, 2,700 rules. And, here's the deal. If we don't completely understand it, then we're going to potentially make some costly errors, right? So we all need to understand it. That's why I say we need guidance. I don't want to do this alone. And I want you to explain, some people say delaying the start of those Social Security benefits is a better idea. So talk a moment about that, please.
Yeah, absolutely. Everyone has an opinion on this. And so I'm just going to tell you the facts, and then I can tell you what we look at behind the curtain when we're helping guide families in making this decision. So
Okay.
if you start taking benefits at age 62, rather than waiting until your full retirement age, your FRA, which typically is 67 for most families, you can expect a 30% reduction. So they're penalizing you 30% by taking it early. If you want your money and you want it now, it's going to cost you about 30%.
Wow.
By waiting until age 70, which I know seems like forever, the benefit is 77% higher than if you started receiving at 62. Think about that, 77% higher. And most people underestimate cost of living adjustments on Social Security. So if we pull back the curtain and share with you what we look at for clients, number one, we look at is what's the age difference between you and your spouse. I just met with a couple yesterday. One was 47, one was 61. Well,
Hmm.
there's a very legitimate age gap between those two
Mhm.
spouses. That needs to be factored in. Number two, how old were your parents when they passed away? Now, I get a kind of some of the weird looks because maybe a financial advisor has never asked you that. But isn't that important? Like, if your parents have lived into their 90s, shouldn't I know that? If your parents died in their 60s because they smoked and drank, but you've never smoked and drank, doesn't that factor into your health and your longevity? Then I ask you about your health. Have you ever had cancer, heart disease, diabetes? It doesn't mean you're terminal if you have any of those, but it does mean that we need to factor that in to your longevity study. The next thing we look at is who's been the primary income earner this whole time. Maybe y'all both have made the same income. Maybe there's been a big discrepancy in your income. The next thing we look at is what have you decided on with your other pensions? Some of you have decided that your spouse is not getting a survivor benefit. Maybe you're retired military, and instead of choosing up to 55% SBP, survivor benefit protection for your spouse, you didn't take it. Well, maybe you're getting 30% VA disability. Well, that VA disability is going to go by the wayside too if you pass away. So I just don't want any spouse to say, hey, my income just dropped by 70%, but my bills didn't decrease by 70%. My
Mm.
bills didn't even decrease by 50% when my husband passed away. That is a reality I don't want to face with a client, that because we didn't plan and take Social Security appropriately, we put that surviving spouse, that widow that you left behind, in a real pickle. And so that's why when you decide on Social Security, you have to think more than just what you and your as a couple are going to receive over a lifetime and how long you have to wait to receive it. You have to say, what is my spouse going to receive if I pass away?
Right. Such a good point. You have to factor all that in. A lot of stuff there. Now, I want to ask you this. By waiting until age 70, our benefit would be about 77% higher than if you started receiving Social Security at 62. Are there any disadvantages to waiting to start benefits?
Yeah, of course there's disadvantages. I mean, I can play devil's advocate, and I oftentimes do. Like many times, we'll tell a client, you need to take it early. Like you've had a diagnosis of cancer once or twice in your
Mm.
life. All your family members have died in their 60s and 70s. Maybe you do need to take Social
Mm.
Security, and the reason why is you can't bequeath or give away your Social Security benefit that you did not take. The government gets to keep it, and oh, by the way, they only have IOUs in that bucket anyway. So it's just one less IOU to you that they have to pay out. So I think it's really important for some families that they do need to take it early because then it allows them to save their TSP, their 401k, their IRA, and pass that on to their heirs So for some families, we do recommend it. But I will tell you, generally, what we're going to do as a best practice is have one spouse take it early and one spouse take it later. And the logic there is remember that Social Security is not a 2-for-1 deal. If one of you passes away, you're going to keep the largest check and lose the smallest one.
Mhm.
So we want to leave that largest check as possible for that remaining widow and spouse. So this is the logic behind taking one early and taking one later. But deciding who is going to be the one that we take it later, deciding when to take it, that's all the things that as a financial planner that we sit down with our family, we build that into our overall income plan. Again, you can't make these decisions with a microscope. You have to look at the whole situation, looking at pensions, looking at the investments, because they all play in as a factor to when we take Social Security.
Exactly. And that's why we're offering you a chance for you to come in and visit with Andrew and our awesome team and at Swan Capital, and they can look at your income needs. They can look at maybe when the best time would be for you to take Social Security. Okay. So here's the phone number again. Call or text the word SWAN, 800-848-8768. Call or text the word SWAN to get on their calendar complimentary, 800-848-8768. Remember, SWAN stands for Swan Sleep Study, or I mean, it actually stands for Sleep Well at Night, with the goal of helping you sleep well at night. They want to help you plan out your retirement, and they can talk about all these needs. And that's what we all kind of are worried about: is what is your money saying? What should I be doing? When should I claim my Social Security? So, anyway, thank you for joining us. Name of our show, What Your Money Would Say, with Andrew McNair. I'm Luann Fulmer. So, with all these factors to consider, trying to figure out your own best path, like I said, would be really hard with all the rules and the operations manual of 20,000 pages. Is there someone at Social Security that we can actually talk to about what's best for our situations?
This is really sad because you would think that every local, every state would have financial planners available on standby at Social Security to give you advice, to give you income planning advice, tax advice, estate planning advice, and how that factors into when you take Social Security. But it doesn't exist. There's no position, and sadly, people are being let go from federal workforce, and that's going to be less and less people to give you advice. And so you can expect even less services, which again, the government's very bloated. So makes sense in some ways to do that.
Mhm.
But the issue is who else is going to help you decide on Social Security? For example, what if you're still working and you're working part-time, making $40,000 a year, and you think, well, I need to take my Social Security, but you forget that because you took Social Security before full retirement age, that you can only make up to $23,400. And so now you're limited to how much Social Security benefits you get, because now they're starting to take a dollar for every $2 that you make. And so this is why we ask all the questions that we do. Not only do we ask all the questions that I talked about previously, we ask, how long are you going to continue to work? Is there a
Mhm.
likelihood that you'll work part time? Then we ask, tell me about the taxation of your money. If you have money sitting in a CD that is taxable, meaning you're just paying taxes over and over again, why not shift and pay out your income out of that CD, delay Social Security, because only up to 85% of Social Security is taxable, while the 100% of the interest on your CD is taxable. And so these are all the discussions that we make, because the last thing I want to do is, if a client has a really well performing investment, be it in real estate, private equity, stocks, that's performing really well, we don't want to spin that down to actually take Social Security. Instead, I'd rather them take Social Security early and let that investment grow at double-digit returns. And so this is why it's a case-by-case situation when you should take Social Security, and you don't have to go it alone. So again, give us a call at 1-800-848-8768 so that you can take us up on our Swan Sleep Study. This is a complimentary visit. I'm buying 1 hour of my time with one of my advisors or me to walk through income planning decisions like taking Social Security. We'll also, if needed, bring in our CPA, our estate planning attorney, to review your legal documents or your tax returns to make sure that you have a complete picture of your finances before you retire. Again, it's easy to retire. It's really hard to stay retired. And that's what we can help you and your family do.
That's right. We want to help you stay retired, and we don't want you to make mistakes. I know you've seen people make, mistakes with their money, and they could have have maybe been, earning a little bit more. That's what it's all about, making your money last as long as it needs to in retirement. So, I want to mention your locations, Andrew. You have offices in Pensacola and you have them in Daphne, Alabama. You help people really all over the country as well, don't you?
Absolutely. And I mean, this reminds me of a visit I just had yesterday with a widow that came into our downtown Pensacola office. She was not yet 60. Well, if
Aw.
you pass away and you leave a spouse that's not yet 60, how are they going to be able to take Social Security benefits? Because a widow has to wait till age 60 to collect on your Social Security benefits. And
Mhm.
so that really puts a widow in a bind. And that's why it's important, as I said, to look at a comprehensive view of your finances to make sure that if you pass prematurely, that there's life insurance in place, that there's investments in place, that there's investments they can access at pre 60 years old, because some assets are tied up potentially if they're not structured and titled correctly for that remaining widow. So a lot goes into deciding on Social Security and in deciding how your investments play well with your Social Security.
All right. That phone number again is 800-848-8768. Call or text the word SWAN. And we'll continue our discussion on multiple strategies to claim your Social Security benefits, all coming up next on What Your Money Would Say. Hi, I'm Luann Fulmer here with Andrew McNair. So happy to have you along with us today. When it comes to the important task of optimizing your Social Security retirement benefits, the prevailing advice from most articles and expert commentators actually focuses on the strategy of delaying the age a person starts those benefits. So, Andrew, for those unable or unwilling to delay benefits for a larger monthly payment, what are some alternative strategies to optimize their Social Security benefits?
Well, the first step, Luann, is making sure that you have a copy of your Social Security statement. Many times, people don't even realize that someone has already applied for their Social Security and applied for Social Security disability. And this can happen to even young people. Why? Because Social Security is not even on their radar. And so people have actually maliciously have filed for their Social Security, changed the bank account to be their bank account to the fraudster, and actually been receiving benefits, which affects your earnings records in retirement. So, fraud, as you know, and cyber crimes are rampant.
Yeah.
And so I encourage you, go on to ssa.gov, get a copy of your statement, make sure that no one's filed your Social Security, and then start looking at your earnings records. And make sure once you've logged in that you review each year's earnings and your statement to ensure all your earnings are correctly reported and no employment years are missing, because this is really important. If you discover discrepancies, you need to report them to the Social Security Administration via the hotline, via mail, or at the local office so that you can get the maximum Social Security benefit that you're entitled to.
Oh my gosh, that scares me. Does that happen often? Have you seen that?
Luckily, not too often. I've
Okay.
had a few situations that I've heard of that have happened to younger people
Oh
because, again,
my.
they're not thinking about it. Now,
Yeah.
again, if someone's about to file, they're going to go after someone that's not going to file for a while. And so
Right.
someone could file for Social Security disability under your name, under disguise of your name, and be receiving benefits, which affects your earnings records. And again, do you think Social Security, that very large organization, can fix that problem overnight? No way. It takes weeks and months to fix situations like that. So you want to fix this as soon as possible because it can affect your earnings records.
I want to go back to what you were talking about regarding, claiming your Social Security benefits and then continuing to work. Okay, give us some more details about how continuing to work after collecting impacts your financial situation.
Yeah, there's a lot of decisions in retirement. Like maybe you get a little stir crazy and you want to work part time. Well, some income is not going to count for Social Security, like pensions and investment income and rental income. But what could count for you is your earned income. And so this is why, if you have, let's say, a business, we sometimes will have one spouse take Social Security. We still pay out salary and income from that business to the other spouse so that we can beef up their Social Security. And this is where, if you own a business, it's very important to make sure that you're thinking about Social Security strategically. So, for example, with my wife, Natasha, she actually gets a small salary from the business so that we can contribute to a 401k. But we actually put most of the income and dividends going to my social security number and my social security record. Why? Because if she doesn't have enough credits to apply for social security, she's going to get half my social security. If she just has very low income, I want her to have the biggest benefit possible, which is going to be based on my benefit. If I pass away, I want her to get my benefit. And so this is why it's very important, especially if you're a business owner, to navigate and manipulate your Social Security earnings for your benefit. So it's really important to understand that benefits from Social Security are calculated based on the 35 highest earning years. So when you're working an extra 1 to 2 years in retirement, you are actually pushing off some of those 1990s numbers that you had very low income compared to your income today.
Okay. Now, I want you to go into the penalty for those who do continue to work while they're receiving Social Security benefits. Talk about that just for a moment.
Certainly. So there is an earnings test that is imposed on your earnings, again, earned income, not rental income, not previously earned income. People think that their pension's earned income. It was a while ago. It's past earned income in the form of a pension. So the threshold for this test adjusts annually. So for every $2 that you've earned over this limit, Social Security is going to claw back $1 and it's deducted from your Social Security benefits. So what they've done is they've deterred people from taking Social Security earlier by putting in this earnings test. And so, again, if you're going to plan to work part time, you're just one of those people that has to stay active. You can never just stay in one place, and retirement is something you're going to have to ease into. Well, then we need to decide on taking your Social Security maybe in a different fashion because of this situation. Maybe we take her Social Security earlier while you go out there and continue working part time. All of this must be structured into an income plan. Don't go into retirement with a bunch of statements, a bunch of portfolios, a bunch of pie graphs, and not have an income plan on your asset spend down. Which buckets are you going to take from in retirement? Which buckets are going to last long enough so that you never run out of money? What bucket are you going to take from when there's market volatility? When are you going to take Social Security? How about, are you going to decide to take the survivor benefit on your federal pension or your state retirement? All of this factors into a great income plan. So again, even if you're working with a financial professional, you want to make sure that you have outlined a income plan, not just using an Excel spreadsheet. I love the Excel spreadsheets that my engineer clients have brought to me, but most of them sadly don't factor in cost of living adjustments or their early demise. And all of this must be factored into a really good income plan. And Luann, I'll tell you what a good income plan looks like. I can tell a client what their max spend number is. That means I can tell them basically the permission slip of how much they can spend in retirement without ever having to worry about running out of money. So I can tell a family, you can spend $7,500 a month without ever having to worry about money, running out of money. And that is so exciting. Like a lot of clients are like, are you serious? Like we only thought we could spend 3,000. We were worried about spending 4,000. I'm like, no, you can spend 7,500 without ever having to worry about money. And I think this is really important too, Luann, especially with sadly how many plane accidents we've had in the
Oh,
skies these days.
mhm.
Is when you jump on a plane, you want a 99% probability of getting to your destination. And when you retire, you want the same confidence. Like you want to have a 99% probability that you're never going to run out of money. It's no good to think, well, gosh, I hope I don't live to 92, not because my health may run out, but because my money might run out. And so this is why it's important to have an income plan going into retirement.
And that is why we do this show, to give you some guidance, to help you. You know, we give you the information about retirement with the goal of helping you sleep well at night. And that is SWAN, okay? The SWAN sleep study is what Andrew and his team take you through when you go in and see them. It's a complete plan. It's going to help you come up with income strategies, investment strategies, tax efficient strategies, healthcare strategies, and then estate and legacy planning. So this is what Swan Capital does. They are a retirement firm that will guide you, help you understand what your money is saying. That phone number is Again, 800-848-8768. Call or text the word SWAN to get on their calendar. So again, you're buying 1 hour of Andrew's time and another financial advisor at Swan Capital. So take advantage of this. Call or text SWAN 800-848-8768. The other thing too I need to mention, check them out on their website, swan-capital.com. Great information there. Great resources for you as you head into retirement. Thank you for joining us. This is What Your Money Would Say. I'm Luann Fulmer. Andrew, my husband Bobby is turning 65. And so he has said to me, I think what I'll do is, at my full retirement age, which for him is going to be 67, I think I'll start claiming Social Security. Okay. Which you can do. I know you explained that already. But I want you to talk about some of the tax implications while you continue to work on Social Security.
Well, up to 85% of it's going to be taxable. But here's why that can be a great idea for some families to take it early. You asked earlier why we would recommend someone take it early. And one thing I didn't talk about is when someone has high interest rate debt, for example. So let's say you had a 10% credit card, a 9% personal loan, you have an auto loan that's at 7%. If it's tied to a depreciating asset, sometimes we'll actually recommend families do take Social Security early and face that penalty of taking it at 62 or 64, whenever is earlier than their full retirement age. And the logic behind that is you're paying so much in interest, and it's probably keeping you from retiring or having the retirement income you want. And so what we'll do is we'll take all of that cash flow. I'll say, hey, you were fine without receiving this Social Security, and you're about to receive the Social Security check. Let's pretend you've never got it, and we're going to funnel this into a debt snowball, make Dave Ramsey happy along the way, and pay down all of this debt. Now, you have to factor in that Social Security is going to be taxable. So even though it might be a $2,000 check that you're taking early, well, we're going to have to withhold taxes. So you may only get $1,800 or $1,600 of that amount. But we'll use that $1,600 or $1,800 a month to pay down all of those depreciating assets debts, so that when you get to retirement, maybe only debt that you have in retirement is that very low interest rate mortgage that you have.
Mhm.
And by setting families up for success like that, it improves their net cash flow going into retirement so that they can spend more and not have the burden of debt on their shoulders.
Yeah, okay, and that's what he thinks, that's what he's gonna do, just whatever he gets from Social Security, like, use it to pay down, well, thankfully, we don't have much debt, but use it to pay down certain things or
Sure.
whatever, so,
Or do some maybe some early renovations.
yeah,
Like a lot of families are like, if I
yeah,
can just get the new windows in, I'll finally retire.
right? We need kitchen cabinets, ours are terrible, they're terrible,
Yeah, those are
they
not
really
cheap either.
they're not cheap, no. Any additional tips to help people optimize their benefits?
Well, I just would think about your asset spin down. I mean, no one taught me this stuff in school. Like, I didn't take a class called Wealth 101 on high school and learn all this stuff. I had to learn it through trial and error of watching many families come to us 10 years into retirement saying, I wish I would have done this differently. And so, what I get to do every day is help you look around the corner and say, from other people's mistakes, not make the same mistake for you and your family. And one of those is asset spin downs. When you get to retirement, do you take it from your municipal bond first? Do you take your income from your IRA first, or do you take it from your Roth IRA first? And this is why when we build out an income plan, we're going to look at the total tax situation of taking Social Security, deciding to take your pension at a certain age when you can elect to take it, and factor that into what's your total taxable income. And sometimes we're going to take it from the brokerage account first, your CD first, then we'll go to the IRA, then we go to the Roth IRA. And generally, that is the best practice. We want to spend down taxable accounts first, then non qualified assets next, then IRAs or qualified assets third. And then lastly, we take tax free investments. And the reason and the logic behind is if I'm leaving a widow tax-free assets at the end of my life, I want to leave them as much tax-free assets as possible, because again, they're going to lose their Social Security check, pick up mine, and then they're going to need as many tax-free assets as possible, because widows sadly are single taxpayers and could pay more taxes. So all of this needs to be factored into your income plan. But if you're settling for statements, settling for portfolios in a mix of stocks and bonds, that's not an income plan. What we need is a actual legitimate income plan that maps out what our income is going to look like in retirement, because retirement isn't linear. You're going to spend different money over times of the phases based on your health and your goals and bucket list items in retirement.
All right. With that, the phone number again to call for a complimentary appointment 800-848-8768. Call or text the word SWAN. We'll be right back with the rest of our show. This is What Your Money Would Say with Andrew McNair. Hey, thanks so much for joining us today. I'm Luann Fulmer here with Andrew McNair of Swan Capital. We all know that we have all heard we've all heard words of wisdom, and some of those can stand the test of time. Sometimes you hear them from, celebrities or historical people, things like that. So today, I thought it would be fun to do our timeless advice again, Andrew. We've done this before. I'm going to give you a quote, and I want you to talk about what it has to do with retirement planning. Okay?
Happy to do it. I think it's important who we take advice from. Like, I don't take relationship advice from Taylor Swift. And so I do take financial advice from people that have a good track record of it.
Exactly. Okay, so here's our first one. This is from Ben Franklin. Okay, we all know this one. A penny saved is a penny earned. What does that have to do with retirement?
Yeah, Luann, I love this quote because Benjamin Franklin, I mean, he's on the $100 bill for a reason. The guy was brilliant. And so when you're close to or already in retirement, how much you do or don't lose can be just as important as how much you make with your investments. So it's really important that we try to save as much money as possible.
Okay, I love that. Every time I find a penny, I think of that. I just earned a penny and I just earned it. I
That's
just
right.
found it, I found it. This is another one from old Ben. He was a pretty smart guy, so we have a lot of quotes from him. He says this, wealth is not his that has it, but his that enjoys it. What does that mean to you?
Mm. That's so true. And you know what's funny is on our logo of What Your Money Would Say, if you're actually watching the video version of this, you would see that Benjamin Franklin with some cool sunglasses is behind me. So Ben gets a lot of credit around here. I mean, you
Yeah.
could take it in the direction that wealth is more than just money. So don't think of it purely in dollars and cents. You need to have money to retire, but you need to make sure that you have plans that will be fulfilling in retirement. I mean, sadly, some people actually come to me, Luann, and I ask them, when are you retiring? And this happened actually yesterday. They said 3 people in my office are retiring. So I guess it means that I should retire too. And I thought, wow, he's being peer pressured subconsciously into
What?
retiring because that's what everyone else is doing. This is your life. You need to make the bucket list of your dreams. You need to sit down with your wife and say, what does retirement look like for us? When do we want to be financially independent so that we never have to work ever again? This is your retirement at stake. So we're not just accumulating money for money's sake. I always joke, I think Warren should get the credit for this, but the pastor once said that money is a lot like manure. It doesn't belong in one pile. You want to spread it out and you want to put it where it needs to go and fertilize the areas of your life that need some pruning and that need some love and care.
Right. And I do love that idea of it's not just the money that you have and how much, it's earning as far as, as you're saving it and, investing it and all that, but what you're doing with that money, what you're
Hmm.
doing with that money and you're building, hopefully building some memories with family, your loved ones, going on some wonderful trips and everything. So definitely enjoy the wealth that you've saved. Like you said, you don't want to be people, who die with all this money left that they didn't do
No,
anything,
I mean, it's about a legacy too. I mean,
Yeah.
that's why one of my books is The Giving Crisis is we can actually do a lot of good in our community. We keep on looking for leaders to rise up. We keep on looking for philanthropists to give towards a worthy cause. And sometimes it's because God created you to give that money and to be that
Mm.
leader. And so that's the legacy that I feel entrusted to do and the responsibility of money. And so wealth should be enjoyed, but it also should be given away too.
That's such a good point. I'm glad you brought that up because that's another thing that brings us satisfaction, right? We enjoy it when we do give it away, whether it be
That's right.
to a charity or to our family or whatever. I do want to mention your book, The Giving Crisis. It's available on Amazon. So that's so exciting.
You can listen to the audible version. Like if you thought I haven't heard enough of this guy for the last hour on the radio show, you could listen to a few hours of me talking through my book.
Oh,
So
I love that. That's awesome. All right. And let me give out your phone number too right now while we are at this point in our show 800-848-8768. You may call or text the word SWAN for a visit, a discovery visit where you go over, they call it a SWAN sleep study, and you look at what you've done for retirement, not just your investments. No, no, no. Do you have a retirement plan? And they go over that. You give them a report card, right? And tell them how they're doing.
That's right. We give them a what we call a sleep study, and it's a retirement report card. We tell you in estate planning, tax planning, long-term care, asset protection, income planning, do you have straight A's going into retirement? And one of the soft parts we're going to talk about is when you're going to retire and what are you going to do in retirement. And so one of the joys of my life, I mean, it is an awesome part of my job, is I get to encourage families to spend more and travel more. As someone that's went to 41 countries, people say, you must have the travel bug. Why do you go to so many countries? It's because I've lived so many lives watching clients that say, I wish I would have traveled earlier. I wish I would have traveled while I was working. And so that's because I've learned from other people's mistakes. So if you want to learn from the hundreds of families that we've helped retire and you want to short circuit and get a shortcut to all of their mistakes as well as all their successes, that's why I encourage you to come in for the sleep study and we'll share with you some of the best practices that we've learned from hundreds of retirees. So give us a call at 1-800-848-8768. That's 1-800-848-8768.
You can call or you can also text the word SWAN to that number if you're a texter like me. All right, we are giving some timeless advice here. I'm giving Andrew some quotes, okay? And then he's telling us what this has to do with retirement because that's what we do on our show. We talk about retirement. Yogi Berra, obviously, one of the most famous baseball players of all time, very famous for all his yogi isms. And this is one that he used a lot. A nickel ain't worth a dime anymore. What's he talking about here?
I mean, you gotta love Yogi Berra because, I mean, again, great baseball player, but also just full of great wisdom and funny quips. And he was born around the same time my grandfather was, and so I spent a year living with my grandfather. When my grandmother had passed away, my grandfather had been married for over 60 years. So here's a
Mm.
bachelor. Here I am in my 20s. I'm a bachelor, and my mom recruited me to go spend a year with him. And it was one of
Oh,
the best years of my life. Like I thought I was doing him a favor, and he
yeah.
really was doing me a favor because
Aw.
he would share these kind of yogiisms with me. And the reason I want to share with you about my grandfather is he told me about how much he spent on things growing up. And he retired at the age of 51. He was not just independently wealthy, he served in the Navy and retired from the military and just did a good job saving, raising the Great Depression. And so, what was really neat is for him is he saw how technology was advancing, but he also saw how prices were advancing. And in his lifetime, he saw prices double twice. Think
Wow.
about that. If you take a 4% inflation rate and you take the rule of 72, 72 divided by 4, every 18 years or so, you're going to see prices double. That's what the rule of 72 shows you is how quickly money will double and also shows you how fast things will double. And so I think it means that you really need to make sure that your money is fighting against inflation because a nickel ain't worth a dime anymore. And supposedly they're going to stop printing some of these pennies and dimes and nickels because it costs more to print the thing than it's actually worth.
Oh my gosh, that's so funny. Yeah, I always go back to when I was a Girl Scout and we'd go on our weekend camp outs, you know. We'd go to Quick Shop and I'd have a quarter and a penny for tax, okay? So 26 cents. And I would buy penny candy. So you'd get
Mm.
everything from bubble gum to Jolly Ranchers to Tootsie Rolls and Jawbreakers and all that stuff. And, that's 25 pieces of candy. That's going to last you for sure all weekend. And maybe I'd splurge a dime on a candy bar or something like that, you know? And oh my
Wow.
gosh, think about that. I'm 65 now. And back then I was probably, I don't know, 8, 9 years old. So, or 10, let's say. So, yeah, 55 years ago, I don't even know what that is, but things have certainly gone up. And that's going to happen in retirement and so that's, like your grandfather was saying, you've got to stretch that money to last because things are just going to keep getting more expensive and more
And the
expensive.
longer you live, the scarier it becomes because my grandfather lived to be 93. So, I
Oh,
mean,
wow.
the longer you live, the more inflation takes its toll.
Yeah, it does. So anyway, that's why you have to have a plan. And your plan, Andrew, when you work with retirees, how far out do you? I mean, you don't know how long everyone's going to live.
No, I
So
don't.
what do you go to?
So
100 or what?
yeah, I mean, 100, 120, and
Yeah.
I know that's shocking. You think, I don't want to live to 100. Well, my oldest client was 104. So,
What?
but
Aw.
94, 84, 74, 64, did he think he would ever live to be 104?
Yeah, yeah, that's so cool. Okay, final timeless advice here from Mark Twain. He says October. This is one of the most dangerous months to speculate stocks in. The others are July, January, September, April, November, May, March, June, December, August, and February. I think I named them all.
I think you did. Mark Twain is spot on. I mean, volatility is to be expected. Actually, there is a high probability every time you're invested in the stock market that you could see an intra-year swing of as much as 5%, 10%. 20%. And this is really important when you're actually in retirement. When you're saving for retirement, it's okay. You're not going to retire and take money from your investments quite yet. But when you retire, the game completely changes because one of these intra-year swings could be a tragedy to your retirement. And so you do not want I don't know, the probability of never running out of money being up to chance, being up to the year that you actually retired. That's too much risk to take. And so you have to understand that market volatility is not your friend in retirement. During saving for retirement, it is your friend because you're buying while the market is down. You're doing dollar cost averaging. You just don't want to be in a dollar cost ravaging standpoint so that when the market is going down, you're losing money that will never recover because you're spending it and enjoying it.
All right, we are about out of time, so no more timeless advice. I think just one more piece of wisdom from you, Andrew, about retirement planning.
Luann, this is my words of wisdom. Right now, I'm in the process of renovating our new office, and we're putting together what the fire plan is. And I would tell you that the words of wisdom are: don't wait till there's a fire to look for the fire extinguisher or look for the fire
Mhm.
plan.
Yeah.
You should know it ahead of time, and that's why we go through drills, and we have our children in elementary school go through drills. And this is the same reason why we have a retirement plan. Don't wait 3 months until retirement to say, I hope I'm going to be able to stay retired. And that's why I encourage you to take us up on our sleep study so that you can sleep well at night going into retirement. That's what SWAN stands for: sleep well at night. I want the goal of every retiree to sleep well at night in retirement. And the only way I know how to do that is by having a plan and having all of your legal, tax, financial, and insurance documents in one binder so that you and your family can sleep well at night. So again, give us a call at 1-800-848-8768 to build that plan. Again, that phone number is 1-800-848-8768.